Hey there, today on the Final Bar, I'm joined by Sean McLaughlin from the StockCharts team. We're going to talk about the overall market environment. Happy bear market phase, and I say that with a little bit of sarcasm. Market's down pretty heavily today. It's all about how the short-term movements relate to the long-term. We're going to look at the big picture. We talk about S&P 4550 still holding, even as we finish near the lows of the day. But what sort of damage has been done, and what areas of the market, particularly tech, holding up? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using data visualization techniques, technical analysis, behavioral finance concepts to better understand investor behavior and focus on the trends. And when you talk about the trends, it's all about looking at the highs and the lows and looking at the trends, those patterns in price behavior. And while the market has certainly shown some weakness here in the last week or so, starting on the Friday after the Thanksgiving holiday, continuing on today with further downside movement. Again, there have been plenty of potential headwinds for stock prices up until now. The fact that the market is now acknowledging certain things and really translating those into downside pressure is certainly an interesting development. As always, it's all about defining your risk. It's all about identifying what I would call the lines in the sand. At what level do you agree to revisit this position or this thesis or this idea? We've talked on the show about S&P 4550 being a pretty good place to look. That's the high from early September. That's the level at which you may want to reconsider the overall bullish configuration, also the 50-day moving average. We're near there. We're not quite there, but another day like today will take us quickly through that support level. We'll look at all those charts together here in a moment. We have a great guest today, Sean McLaughlin from StockCharts. I'm excited to talk to Sean again. Tomorrow, on Wednesday the 1st, we have Tony Dwyer from Canaccord Genuity in New York. On Thursday, Mark Chaikin from Chaikin Analytics, developer of many of the technical indicators we have on the StockCharts platform, going to be joining us and talking markets on Thursday. Next week, on Tuesday the 7th, Mark Newton. On Wednesday, December 8th, Gary Dean. Two other quick things to announce to you. We just had our most recent episode of The Pitch yesterday. It aired yesterday evening. Jeff Hughes, Dave Landry, Julius DeKempener all sat down with Tom Boley, shared 5 ideas each, stock and ETF picks, and backed them up using the charts. If you missed it, go to stockcharts.com/thepitch, and you can see all of our previous episodes, including that one from earlier this week. Also, our holiday special is upon us. All through between now and the end of December, you can renew or you can join in as a StockCharts member for a special deal. Go to stockcharts.com/special. You will see our holiday special. It is ready to go, and it is a really good time to re-up your commitment to your portfolio, to your improved decision-making using the StockCharts platform. So check that out if you're interested. Let's continue on today's show with our market recap. We're going to start with a poll. We always have a poll running on our StockCharts live stream page on our website, also through social media. And we asked you recently, which of the Americans performs best over the next 3 months? And I gave you 4 choices: American Airlines, American Express, American International Group or AIG, and American Eagle Outfitters, AEO. And this comes from a chart we used to have in the Fidelity chart room. It was actually predated me. This was in the 1970s and 80s. They had a chart called the Generals, and they would track General Electric, General Reinsurance, General Motors. And their idea was that was basically represented the core of the economy, all these stocks named the Generals. 44% of you said American Express AXP. Second to that was American Eagle Outfitters with 23%. The worst vote getter was American Airlines. Now, I definitely agree with you. Out of those 4 stocks, AAL probably the least attractive from a technical perspective. And of course, I'm asking that on a week when these names have just broken down. Friday really took these stocks below their most recent swing lows. And AAL is just one of those, right? Delta and Southwest and a number of them all have similar sort of breakdown patterns. They've all stabilized in the last day or two. And so they've stopped going down, at least in the short term. But overall, I'd much rather own stocks that are showing signs of accumulation, not charts like AAL that are showing signs of distribution. You compare that to the chart AXP, and it's interesting that we got a lot of response for this. Maybe all of these charts are looking pretty vulnerable, because the problem I have with American Express, we actually highlighted this on the show yesterday, I want to say, but quite a breakdown. And I think what concerns me on a chart like AXP is the fact that you had support in June, you had support in August, support in September. We've broken those levels now, and you broke the 200-day moving average. And in general, if I have a choice to own a bunch of stocks above their 200-day or below their 200-day, generally speaking, I'm probably going to want to go with the ones above there. So then we're left with AIG, which looks like this, and American Eagle Outfitters. Boy, I really didn't give you a lot of great choices. The Americans as a group are struggling a little bit. I would probably pick AIG out of all of them, only because out of the group, this is the one that's probably held up okay. It's breaking down through its 50-day. It's nearing its 200-day moving average. I didn't give you an option for not an American stock without that in its name. I'd probably be looking elsewhere if I had the opportunity to do so. Let's continue on our market recap, looking at the damage that was done today. So most things, if not all things, down. Not all things. And I was talking to my guest, Sean McLaughlin, before we started. He pointed out what I had noticed, which is Apple making new all-time highs. Had a bearish candle pattern about a week ago. It's called the shooting star candle. The open and close near the bottom of the range and a big upper shadow, which is a short-term negative pattern. Apple pulled back in the last couple of days, but as you can see from the little preview chart on the market movers panel, just continuing, pushing upwards, higher highs and higher lows. So nice upward move. So in general, stocks in good upward trends that are not going down are good stocks to own at any point, but especially at a period of market dislocation when things are rupturing a bit. The S&P finished today down about 1.9%, not quite to our 4550 level we've been talking about, but really close. We're within a rounding error away from that level, 4567, the closing level there. Mid caps down the most, 2.6% lower, small caps down 2.1%. The VIX, by the way, is up above 27. It was not too long ago. We're talking about a VIX in the mid-teens, and look at how quickly that has spiked up. Now, one of the highest readings for the VIX this year. We'll talk about that in a little more detail later in today's show. A couple big things, and I ran out of time or focus to be able to get all of the different things hitting the market today. But the two things that hit me early on that I think the market processed through the course of the day. Number one, you have the Omicron variant and just the unknown. I think in general, when I've been asked in interviews, I tell them in general, the market likes certainty, and the market does not like uncertainty. Generally speaking, that's what risk assets are going to do for you. So the fact that we have this unknown potential variant, and again, we're learning more about it every time, but still unknown in terms of the impact, unknown in terms of how this is going to, affect how we travel, how we consume, how we, buy and sell goods, all of those sorts of things. But there's certainly some potential impact. The market is digesting that as a net negative, and you're seeing that. You also have comments from the Fed, and this is somewhat laughable only because we've talked about how inflation doesn't seem super transitory. I've mentioned that a number of times as it was described as transitory. Now we're acknowledging it's not transitory. I feel like the market has acknowledged that well before today, but now the Fed, you're hearing more and more commentary that is sort of where we're at. The end of the day, the yield curve essentially flattened out a bit with short-term yields coming up, long-term yields coming off a little bit. And so in general, you have a flattening yield curve, 10-year yields around 144 right now. Commodities down pretty much. Gold was much higher earlier in the day, but sort of settled down to finish lower with the GLD around 165.50 across the board. Weaker commodity prices, though, in the energy sector down about 2.5% on weaker oil prices. Cryptocurrency is actually mixed, more positive than negative, though. And if you're looking for any sort of risk assets that finished in the green, Ethereum, Ether is maybe one of those to highlight. We've talked about the difference between Bitcoin and Ether, and looking at the ratio of the two, and how Ether had certainly been performing more strongly than Bitcoin on a relative basis. A day like today certainly helping to accentuate that difference between these two cryptocurrencies. And again, as we've mentioned before, I think when you have a very new market, a very untested market, an unknown market, you think of it as one thing. And I think you sort of saw that with emerging markets, right? You think of all emerging markets as a thing. But then as these markets mature, as people become more and more aware of them, as people have more and more access to those instruments, then you recognize that EM actually involves China and Brazil and India, which are three very different markets with very different experiences and very different future paths potentially. And I think you're finding the same thing with cryptocurrencies. If you're very early on in your experience with crypto, thinking of it as an asset allocation is totally fine. But once you really look at the details, there's a lot of movements underneath the hood with some of those charts. The market recap could take an entire hour just with the movements we've had, so we have to wrap it up in a minute. So I'll tell you this: the S&P 500, we talk about this pink shaded area, which is right around 4550. We're there. I think we're within a rounding error of that level, and I think we've sort of reached that point. And so I think from here on out, you have one of two things happens. Either we test support, the VIX has spiked, and this becomes one more opportunity where a pullback becomes a viable pullback, and we rally into the end of the year. That's certainly a scenario I could see playing out. What happens though if that does not hold? If we break down through 4550, we break down through the 50-day moving average, and as promised, that is the day. It could be tomorrow. It could not happen for the foreseeable future. That's when you will hear a much more cautious tone in my voice. That's when we'll talk about some levels to think about further below, and 4,300, the next obvious one that I would focus on. Finally, on a day like today, and then we have to wrap it, on a day like today where it feels like everything is down, remember, not everything is down. The fact that the stock's up on the day in the S&P 500, I don't actually have 10 items. I thought maybe the website was glitching. No, that means less than 10 stocks in the S&P actually finished in the green. So that should be an indicator of sorts. But I would look at names that are actually doing okay on a day when the markets are down significantly, right? Apple doing just fine, Pfizer, Bio, Tesla, all going higher. Granted, it is a relatively small number of names, but look on the names that are down, but just not down so much, and focus on some of these stocks that are outperforming on a day when the market is getting ruptured. That can be a really interesting place to focus opportunistically, and it's worth noting technology outperforming on a day when the market is certainly feeling some pain. We need to take a quick break. We'll be back with today's guest, Sean McLaughlin. We'll see you in a minute. Hey everyone, welcome back to the final bar. I'm your host, Dave Keller, here at StockCharts.com. It's great to have you join us every weekday after the close for our show. A couple quick announcements before we get to today's guest, Sean McLaughlin. First off, we're going to do a mailbag segment a little later in today's show, and we would love to answer your question in our next mailbag segment on Friday's show of this week. All of our questions come from you, our viewers. We love to hear from you. Let us know what you're running into as you are trying to use technical analysis to make better decisions. Our email is the best way to get your questions to us, thefinalbar@stockcharts.com. We're on Twitter. Just tag us in a comment at finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show of this week. Also, go to stockchartstv.com. That is our on-demand platform. Great guest presentations like what we'll hear shortly from Sean McLaughlin and many others. Special events like The Pitch, our year-in review coming up in December. So much more, all for free on our on-demand platform. Go to stockchartstv.com. Also on your mobile device, just search on any of the app stores for StockCharts TV on demand. I'm going to welcome on today's guest, Sean McLaughlin. Sean's the Chief Options Strategist at All Star Charts. He's been a frequent guest on the show, always does a great job of helping us put a crazy market into proper context. Sean, we need your help today. Welcome to the show.
Hey, David, how you doing, buddy? That was quite a close we just had there.
Exciting move in the market today, and further distribution. We've seen some signs of distribution before today, but certainly, feeling a little more weight on the averages. We're going to start with your chart of the S&P 500. Help us put a day like this into, proper perspective. What are you seeing here?
Sure. Well, today felt pretty bad if you're a bull, and Friday, that abbreviated trading session also didn't feel too good. But the guys here at All Star Charts, we've been pounding the table for the last few weeks now that with the S&P, if it's below 4,700 or it's above 4,500, we're kind of stuck in a no man's land. If we're above 4,700, that's when we want to start getting aggressively bullish. And if we're below 4,500, that's where we want to start looking to get aggressively bearish. But in the middle, which is where we are now, it's really just a sloppy market. There's a lot of whipsaws happening on a lot of names, a lot of big names. And we think that that's going to continue, at least in the near term. And that's how we're playing it. And David, you like to bring me on because I'm an options trader. And from an options trading perspective, when I see sloppy sideways action like this or range-bound action with volatility spiking, if you want to bring up that VIX chart real quick, we got VIX, poking at levels that it's, kind of bumped its head up against numerous times over the last several months. When you see that as an options trader, you have to recognize that the odds are in your favor to be selling premium here. Selling, a favorite trade for people who trade indexes is to put on iron condors or strangles of some kind. My favorite is an iron condor and a thing like an SPX or SPY. And I've been doing that aggressively starting on Friday last week and continuing today. Selling premium here. Now look, I'm doing it in defined risk, right? I'm doing iron condor type trades. Have defined risk. I know what my max loss is if I'm wrong. And look, VIX, as we know, this might not be the top for VIX, right? The VIX could scream to 50. I mean, who knows? We don't know what's going on with this news cycle. We're one headline away from VIX spiking to 50, right? So we have to be prepared for anything. But as options traders, we like to play the odds, right? And the odds are in our favor here to be selling premium, trying to stay as delta neutral as possible. Let the market cool down a little bit. Let everyone's frayed nerves kind of come back down. And then we'll start taking profits later on. But right now, to me, as an option trader, feels like this is the environment that we need to be selling premium.
There are a number of great points in there, and when you and I have talked, Sean, obviously we usually focus on the options market to some degree, and it reminds me, if you're a plain vanilla equity trader, an environment like this can be super frustrating because you're going that painful third direction of sideways, right? You're not going up, you're not going down, you're going nowhere, so there's not really much to be gained. Can you just talk? We have a minute. So for those that when you say iron condor, they start to sweat because it doesn't really make sense. Can you just explain, generally speaking, what bet are you making when you put that sort of options trade on?
Sure. Well, looking at this S&P 500 chart, this SPX chart here, if I was starting from scratch and putting on an iron condor trade right now, I'd be looking at options about a month out for expiration, maybe 45 days out. And I would be looking to sell the strikes that are just beyond the levels that you see on the chart, though. So right up, maybe selling a call at about 47.15 and selling a put just below 4,500. Those would be the strikes that I would sell. But I want to protect that position. And this is how it becomes an iron condor. I'll buy further out of the money calls above 4,700, and I would purchase further out of the money puts below 4,500 to define my risk. Okay, so the market could completely crash or completely scream higher. At least having that protection, I know going in, I know the maximum amount of money I can lose, and I'll size my position at a level that I'm comfortable, right? Options traders can get themselves in all kind of trouble over leveraging and taking on more risk than they're comfortable. But the way I do it, David, is I like to know what my risks are up front and accept those as a possibility.
I love the way you describe that, Sean, because I think a lot of people, especially when they're getting started with options, they think of it as this, ability to use a ton of leverage and have outsized gains. But with outsized gains often come outsized losses, which can be pretty painful. But you tend to think of it in terms of defining your risk and sometimes defining your upside, but at least having a better sense of things. And I feel like in this sort of environment, having some well-defined risk seems like a really good opportunity. Sean, listen, it's awesome to have you on the show. I really appreciate you coming on, sharing your expertise with everyone. Thanks for talking through the markets with us. Stay safe there, and we'll talk to you again soon.
All right, David, thanks for having me. Always a pleasure.
That's Sean McLaughlin. Sean's the chief options strategist at StockCharts. And it's so helpful when I have Sean on the show and we look at a chart of the S&P, and he's coming at the markets from an options perspective, and with his experience trading the options market. I have very little experience in that environment besides talking with a lot of really smart people like Sean and learning from their experiences and their expertise. And I love how you look at an environment like this opportunistically and think, with volatility increasing, with the market a little more range bound, what can I do to protect myself, and what can I do to identify opportunities given these restraints, given this overall environment? Really good take from Sean McLaughlin, and really appreciate him coming on the show. Let's continue on with our next segment, the Final Bar Mailbag. So as I mentioned earlier, we love to hear your questions. They're always welcome. Shoot us an email, thefinalbar@stockcharts.com, anytime you like. Let's get to the first question. I'm challenged in cases where technicals are disconnected from fundamentals. Instead of buying you last week, I shorted it above $200 because RSI was way overbought, not to mention forward price to sales ratio above 38 times. These are crazy valuations. Your question, by the way, and thank you for sending that in, your question touched on so many fascinating topics that I wanted to include it on the show. Number one, your initial thought. I'm challenged in cases where technicals are disconnected from fundamentals. And I will tell you, from much of my experience in the financial industry working with institutional investors, money managers, this is an area where we tended to focus a lot of times. There are times when the fundamental thesis and the technical story, the charts, line up and are very much in agreement, where they are both very supportive of markets going of a stock going higher, when they're both very supportive of a stock going low, right? Both very bearish at the same time. But the really good stuff is when there was a disconnection, when the charts looked fairly attractive, but the fundamentals did not. When the fundamentals looked very attractive, but the technicals were a little less supportive, because that told you that there's a disconnect between the story and the stock. And I was always reminded that good companies don't always make good stocks, right? Another thing we would say, there are plenty of bad times to buy good stocks for good companies. And so that relationship between the technical and the fundamental, we rarely focus on the fundamental stories on our show. Only given limited time, we focus on the charts, because that's really the core of the discipline that we're trying to articulate for all of you. But I would remind you that looking at that interplay between the charts and the fundamental stories, the earnings potential, the management teams, the catalysts for growth are all very, very important. And I think you're in a great place by thinking of that disconnection and thinking of how you can relate those. Now, you're talking in particular about Unity Software, ticker U, and you're talking about, this is when you sent the question in, when it had just gone above 200. And I think there are a lot of interesting things when you mention it. You have this problem where the stock is very overvalued. You seems like a great breakout because it's going above its previous highs. However, it's overbought and it's overvalued. So here's what I would tell you. To be honest with you, it is very rare that you find a stock going to new all-time highs where the word overvalued is not going to come up. And whether that is deserved based on how much you are paying for $1 of sales or revenues or earnings or whatever, or whether it's just the fact that the price has gone up so much. You have to remember that a price to sales or price to earnings ratio is literally the price divided by some other metric. And when a stock goes up for whatever reason, and the earnings or the sales don't change because the company's not reporting every day, they're reporting once a quarter, that valuation is going to go higher and higher because people are paying more and more for that same amount or that same estimate. If the estimates or if the trailing earnings don't change, you're paying more and more for the same thing, for the same fundamental value. And as a result, it's going to be overvalued. I've learned that not to be scared of the terms overvalued or undervalued, right? Stocks can be overvalued and go up a lot. Stocks can be undervalued and continue to go lower, which is why momentum investing is based on the price and a lot less on the valuations. That's one thing I would say. Number two, I don't have a problem with you thinking a little more defensively when a stock is breaking out and thinking of not just the valuation, but from a technical perspective. This is a stock that became overbought. And what that often tells you is, even though the long-term story might be great, in the short term, you might get a bit of a pullback, which is what we've seen Unity do. The question I would be trying to answer if I'm you, is now that it's been a couple of weeks, now that we have pulled back from $200, we're down about 30 points from that level. It's about 15% haircut from when you sent in the question. Now what? We're no longer overbought. We're arguably no longer overvalued relative to where we were a couple of weeks ago. Does this start to look a little more attractive? And at what point would you start to nibble a little bit more? That's what I would be thinking if I were you. Next question. Has Elli Lily formed a cup and handle pattern? Let's take a look at the chart LLY. You didn't have a chart included, but I'm guessing you're talking about this daily chart right here, which is sort of a 4-month pattern. So not bad. A cup and handle pattern is where you have a big run higher. You have a rounded bottoming pattern, right? So you sell off from resistance, you come back to retest the resistance, and then you have a shallower pullback. So there are 2 reasons why I would say this is not an ideal cup and handle pattern. Number one, the fact that on an ideal cup and handle pattern, this resistance level is super flat. So what you ideally want is a level of resistance. It hits 270, it comes off, it retests 270, and then hits that same point. Ideally, that level is flat. You don't want a slanted pattern going down or going up. That's just less and less ideal. Overall, this doesn't bother me too much. It's actually pretty decent. It's right around $270. I could accept that. Where it's not a cup and handle pattern is because a pattern like this doesn't become confirmed until you validate it by breaking out, right? So this is not called a cup and handle pattern formally until you break above 270, until you indicate that the pattern has been confirmed, it's been validated. We never got above 270, which means it's not a cup and handle pattern. We find the same thing with head and shoulders patterns where you never break the neckline. It can't be called a head and shoulders pattern. You, by the book, could call it a head and shoulders like pattern. You could call this a cup and handle like pattern, but until it's validated with a break above 270, it's not actionable yet. And that's why Elli Lily not really giving a buy signal based on that pattern just yet. We had a question. I'm wondering, when taking a look at a chart of the VIX and the SPX, how to interpret the correlation of the VIX to the SPX. What should I be considering? And I'm so thankful we had Sean on the show earlier. We talked literally about that. I didn't even think about it as I was setting up the mailbag and accepting it. I thought Sean's point was well taken. And if you missed it, I would go back and listen to his thoughts about the VIX. There are a couple of comments we didn't have a chance to dig into any deeper, but I hope you caught the fact that number one, he said, we're one headline away from the VIX going much further. You have to remember that the VIX is not really defined, particularly on the upside. The VIX can go up and then it can keep going higher. We saw that in January of 2021 when the VIX got up to the upper 30s. We saw that in March of 2020 when the VIX went up into the 80s, if I remember right. Those were levels that had not been seen very often. But again, when the market gets uncomfortable, when people start to get nervous, volatility can spike and the VIX could go up a lot. It's worth noting when you look at this general relationship, there's a reason why when the market goes higher, volatility tends to be lower. When the market's going down, the volatility tends to be higher. People call this the fear gauge or the uncertainty index. And that's why, right? People tend to be a little more comfortable, a little more confident. The market's going higher, you're slowly accumulating shares. When you get nervous because of some headline, because of the new coronavirus that we haven't heard of yet, because the Fed says that they're going to stop buying bonds tomorrow, which they have not said as far as I know. But if that sort of headline hits, volatility is most likely going to spike because people are nervous and they panic, and they don't gently kind of panic and slowly unwind their positions. They dump and they get really excited very quickly. And that's why volatility spikes tend to coincide with the market going lower, but it's not a one-to-one correlation. You will find that there are times on a shorter time frame when volatility and the S&P can move together. Great questions. Listen, everyone, thank you so much for sending those in. Keep them coming. Email us your questions. We'll hope to answer yours on Friday, but we need to wrap to today's show. Go to the 3 and 3, 3 charts in 3 minutes. Here we go. We're going to start. All 3 of these charts, by the way, are featured on our Mindful Investor Live chart list, which you can access on my page on StockCharts. Go to the articles tab, go to the Mindful Investor. All 3 of these are on my Mindful Investor Live chart list. We're going to start with a look at breadth. The S&P has come off a little bit, so let's look at the breadth conditions and what they've actually shown us. The S&P 500 breadth line is holding up just fine. It is above its 50-day moving average, although it's really close to breaking it, but overall has made a pattern of higher highs and higher lows. It's worth noting that the mid-cap advanced decline line also made a new all-time high there in the middle of November. 2 of these have not made new all-time highs, which is actually really interesting. The NYSE advanced decline line came right back to its previous high from June, but failed to make a new swing high. The small cap AV line, same thing, has not reached its level from June. So you kind of have a mixed message of sorts. I don't change these colors until the end of the week. So on Friday, I'll certainly take a look at these, and maybe some of these need to go back to more of a neutral amber color. But at this point, you're seeing breadth indicators holding off, tapering off, after having a pretty good run, given the strength of stocks in the last 6 weeks up until about a week ago. We'll also look at the percent of stocks above their moving averages. Still 2 stocks in 3 in the S&P remaining above their 200-day moving average. That hasn't changed a ton. There are only 56, 57% of the S&P members above their 50-day. That's down from about 75% just 2 weeks ago. So in the last 2 weeks, literally about 20% of the S&P has gone below their 50-day moving average. That is an indicator to watch, particularly that 50% level, which often differentiates a short-term corrective pattern with something a little more deeper and a little more sinister. The final breadth indicator, we're looking at a lot of breadth indicators today, the bullish percent index, remaining just about 50%. That's come off quite a bit in the last week or two. It was just around 70% of S&P members in a bullish point and figure chart. About 20% of those have turned negative. Getting below 50% would be a bearish signal. Last time we got that was in early October, so certainly worth paying attention to that as well. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for our show. Special thank you to Sean McLaughlin joining us from All-Star Charts, sharing his perspective. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.